Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing well. How are you?
Great, thank you. We've got a good show today. We're going to talk about something that captivates the interest of most of our listeners for the last 5, 6, 7 years, and that is your investment portfolio positioned for a market correction? It seems to be everybody's waiting for that market correction. They're waiting for the crash. They don't really know what the definition is of each of them. We'll talk about that. We'll also talk about mitigating circumstances that affect your portfolio and what can you do within your portfolio to help against market downturns. So Tyler, to set the stage a little bit, let's talk about, what is a market correction versus a market crash and risk. Let's talk about that to set the stage.
Exactly, Dean. And when we ask the question, is your portfolio prepared for a market correction? Many people then are wondering, well, what exactly is a market correction? And to define that, a market correction is a 10% downturn or a 10% drop from a 52-week high. And it's a downturn that disrupts an uptrending market. So it could happen, any time now. It could happen 1 year from now, 2 years from now, 5 years from now. Obviously, no one knows exactly. But again, a correction, it's a 10% downturn, which disrupts an uptrending market. And as many people know right now, markets, they're currently at an all-time high. So the S&P 500, the Dow Jones, the NASDAQ, they're all hitting all-time highs right now. And we've actually been in a bull market ever since the S&P 500 bottomed out in early 2009 after the recession and housing market crash. So again, that happened in 2008 into early 2009 is when it bottomed out. And ever since then, we've been on a pretty steady trend upward, which leads us to a bull market. And it's going now on 9 years of a market where share prices are going up and investors are buying in. Investors are still continue to be pretty encouraged by the economy, so they're wanting to buy into different investment positions in the stock market, which is something we've never really seen before for 9 years straight. And to illustrate that point, in each decade, the Dow Jones index has had at least one bear market downturn of at least 20% or more, except for the current decade, which there hasn't been a single one yet since 2010. And again, to define a bear market is where it's a market where stock prices fall, encouraging selling, and that's for a total of a 20% drop is what a bear market becomes. And we're not telling you all this to try and use scare tactics or anything like that, but rather to educate investors on the past history of the markets and why it could be smart to consider a proactively risk-managed investment portfolio to try and mitigate losses during the next bear market, whether that's 1, 2, 5, 10 years from now.
Oh, okay. So some people talk about the market. Now we know what a correction is. We know what a crash is. That sets the stage. We'll have people come into our office. We offer free complimentary review of their portfolio. When looking at their portfolio, we'll hear comments quite often. And Tyler, correct me if I'm wrong. People will say, well, I have a conservative portfolio, so if the market goes down, I'm protected. Well, hate to tell you this, but you can lose money in a conservative portfolio. And part of the reason is when we talk about market risk, which is usually pretty severe, that's what we saw in 2008, 2009. We saw that in 2001. Market risk brings the whole market down. So, Tyler, when people talk about diversification and they talk about market risk, what do they mean by that? And can diversification help?
Yeah, good points there, Dean. And one important thing to point out with that is that you cannot diversify out of market risk if you hold any investment in the stock market. So a lot of investors, they may hold individual stocks, exchange-traded funds, mutual funds, real estate investment trusts, other alternative investments that are in the market. And anything like that you hold in the stock market, you cannot diversify completely out of that because they're all subject to market risk. And market risk is simply the possibility for an investor to experience losses due to any factor that may affect the overall financial market. So one example that I like to use quite often is it's from a little over a year ago. It's the Brexit vote. And that was where Great Britain voted to exit the European Union. And that vote happened late June of 2016, so a little over a year ago. And when that vote came through, the very next day, the market, they were all down over 4%. So although that's not a market correction, but 4% in one day is extremely substantial for the markets to be down. So, and with that, no matter what type of investments you held in the market, everyone felt a hit, some more than others, depending on the individual stocks, mutual funds, ETFs, or REITs. But again, everyone felt that. That's what market risk is, where no matter how you're diversified, you're going to feel it because it's a factor that affects the overall financial markets. And so with that said, you can't completely diversify out of market risk, but you can take different steps to minimize the impact. And that's where actively risk-managed investment portfolios really shine and really come into play.
Okay. So really, asset allocation and diversification does not guarantee a profit or protect against loss in a declining market, but it's basically a method to help mitigate against risk. Mm-hmm. So understand that even conservative portfolios will go down when you have severe market risk. Okay, so we have passive investing and active investing, and they play a role when it comes to market corrections and your portfolio. Certain investing tactics, such as passive versus active, could be used earlier in life versus later, whether you're looking to retire, whether you have a substantial amount of money that you want to have go on to beneficiaries, and so on. Tyler, what is the role of the passive investing versus active? What makes them up?
Yeah, and the first one that we'll touch on here is passive investing. And passive investing is what a lot of people refer to as the buy and hold investment strategy. And that's where, like the term is, like it says, it's where you buy into an investment and you plan on holding it over the long term. Whether that's the long term for each person is going to differ, but that might be 5 years, 10 years, 30 years, 50 years. And index funds are the most common form of passive investing, where you buy an ETF or a mutual fund that tracks an index, like, for example, the S&P 500, and you hold it over the long term, knowing full well that you'll do no better or no worse than the market index that your fund is tracking. So if you buy into an S&P 500 index fund and the S&P 500 goes up 10%, you can expect to get somewhere near 10%. If the market goes down 10%, you can expect to lose right around 10%. Now here is where a problem arises with passive index investing. And it's what I just explained, where you get all of the gains, but you also take all of the losses if you buy index funds and hold them. So as you can see there, this strategy might be a bit problematic for someone who is about to retire or someone who's currently in retirement, and especially if they're taking withdrawals from the account. So for example, let's say you have $100,000, just a hypothetical example, $100,000 in an S&P 500 index fund, and we have a severe market downturn and it goes down 50%. So you just took all those losses, you took 50%, and now your investment then becomes worth $50,000. And many people think that now that you're at 50,000, you need to gain back that 50%, right? Because you lost 50%, you need to gain back 50% to get back to even. But that's actually wrong, because you now need to gain 100% to get back to $100,000. And let me take you through this math. It's because a 50% drop takes you down to $50,000, and you need to gain $50,000 or 100% to get back even to $100,000. So then the next question becomes, okay, I took that loss. Now, how long is it going to take me to recover from a loss like that? And I have a few numbers here. If your S&P 500 index fund averages a realistic rate of return of, let's say, 7% after that loss, 7% per year. And 7% in this market is, a lot of people would take that. And if we go by that, it would take you 11 years to get back to $100,000. And now let's say you only lost 20% instead of 50. You would still need to gain 25% to break even. And if your investment average is 7% annual rate of return per year after that, you wouldn't be whole for another 4 years. So either way, those numbers can be pretty scary if you're in retirement, because a lot of people in retirement, they're not going to have 11 years or they're not going to have 4 years to try and make up what they lost, especially if they're withdrawing money, which can compound the problem and make matters even worse, which is really where active risk management can help, as opposed to a buy and hold passive strategy where sure you can get all the gain, but then when the market gets a little bit shaky and it turns into a market downturn or a market correction, you're also going to take all of those losses as well. And like I said, if you're also withdrawing the money, if the market goes down 10%, and you're in an index fund that goes down 10%, but yet you're also withdrawing 5% of your total portfolio value each year, you're down 15% and then some. So that's where active investing can provide a different opportunity as opposed to a buy and hold strategy.
Okay, and a buy and hold strategy, an example here would be those people looking to accumulate wealth while they're working. They typically have a 401k or a 403b, whatever their employer-sponsored plan is called. You are just dollar cost averaging. Every time you get paid, you have some money going to the 401k. It goes in there. Really, some market corrections actually give you an opportunity. So if you are years away from retiring, typically 10 years or more, a market correction can actually give you an opportunity to gain more wealth because you are dollar cost averaging. You have dollars going in there. Every time you get paid, you're buying shares at a lower price. Therefore, you have the ability to have those increase once you come out of the correction. So actually, a correction can help those people who are younger. They believe in a buy and hold strategy. They just hang on to it and they go with the ebbs and flows of the market. Active investing, we typically see more of that as you're closing in on retirement. The great phenomena happens as you retire called no more payroll. And when that happens, those accounts need to stand on their own 2 feet. Typically, that's where you see some active investing come into play. Okay, to help position your portfolio for a market correction, one of the main things that we use is an active risk-managed portfolio. We have a portfolio made up of equity positions and bonds and so on. And the real key here is when the market is good, like now as we're talking, the market has been strong this year. Not every month, but most months. You have probably accumulated some money. You have some equity positions or investments in your portfolio that have probably significant gains. While the market is good, it is a wonderful opportunity to capture those gains. So you rebalance the portfolio. You give a haircut to those positions that have done very well, and you take the cash and you either accumulate cash or you reinvest in other positions that you think are going to have some gains. So let's say we take and capture some of the gains right now. We move it into cash. The key with a risk-managed portfolio is creating some cash when the market is good, when the market is high. You sold high. You took gains. What you're doing is allowing yourself to hang on to this cash. Should the market correct and go down, you can then take that cash and do what everybody wants to do, but is typically not positioned, and that is buy low. Okay, so you sold high, you created cash. We use the cash then. If the market stumbles and it hits a low and it stabilizes at a low, we'll take that cash that was accumulated high, go down low, pick up equity positions, and typically that will bring you out of the hole much quicker than a buy and hold strategy. So an active risk managed portfolio, they really came to light after the 2008-2009 market crash. More and more people were hurt with buy and hold strategies, typically in 401ks because they're working. You have a 9 to 5 or an 8 to 5 job to take care of. You can't be in your account moving it around all the time. So those people were hurt. So as a result of that, you see risk managed portfolios were created, building of cash when the market is good. Now, that is actually contrary to what a lot of people think. They want to hang on to those gains significantly longer. So what happens is you receive gains. If you don't sell some of those positions and take those gains, many times we see the bell curve go right straight back down again. So take the gains, create the cash, have an advisor who deals with risk-managed investment portfolios. then you can use that cash to buy low. If you're just tuning in, my name is Dean Listle. I'm here with Tyler Listle. We are financial advisors with Secure Retirement Solutions. We're located on Allied Street in Green Bay. If you'd like us to take a look at your current portfolio, we have complimentary reviews. Our phone number is 347-9888, or you can go to our website to get our email or to contact us. Our email address, our website address is srsplans.com. SRS stands for Secure Retirement Solutions, plans.com. Okay, risk-managed investment portfolios. Within the portfolio, in addition to cash, you want to make sure that you hold some equity positions, typically in the form of exchange-traded funds and some individual stocks, in addition to mutual funds. We don't like to get too heavy with mutual funds, mainly because in addition to internal fees, not all of them, but some of them with internal fees, they cannot be settled after being sold until the end of the trading day. So if we have a significant market downturn and you are contacting your advisor who claims to have risk-managed investment portfolios made up of all mutual funds, you contact them at 10, 11 noon and say, we need to get out of there. And they say, no problem, we'll sell, knowing full well that they don't settle till the end of the trading day. So a significant amount of the market could go down at that particular time. So we like to use exchange-traded funds and stock positions also. Part of the reason is exchange-traded funds and stock can be sold instantaneously when you contact or when the advisor wants to sell it. So they can be sold, so it adds an element of risk protection to the portfolio. Tyler, am I missing anything here with a risk-managed investment portfolio?
I think you covered a lot of good points there, Dean. And to go right along with that, with an actively risk-managed portfolio, again, we're buying and selling different investments based on the market, and we take a much more hands-on approach as opposed to a passive strategy, as you can probably tell by now, where we aren't just going to let it ride. We're going to buy and sell based on the market. And with these portfolios, let's say we have someone who is 65 years old, they're retired, they have an actively risk-managed portfolio, and it contains, we'll say, 55% stock funds, which are used for growth potential, 35% bond funds, which are used for stability and protection and income, and 10% cash, and the market has a downturn and starts to go down, let's say 5 to 10%, then we might move 30% of the portfolio into cash and 50% into bond funds to try and preserve the portfolio as much as possible. So as you can see, we're not just going to sit there and let it ride and go with the ups and downs of the market when you're 65 years old, retired, and taking income from it. And what we do is we try and do the best of both worlds, where we actively risk manage mini index funds, where, for example, when the market's doing well, we might have 60% stock funds and 40% bond funds, and then slowly building up cash at a high. And then if the market takes a dip, we're going to move more so into cash, and we don't want to ride with that dip just like 2008, because many people who are retired, they can't afford to do that. And I've got a quote here by an anonymous source that said that the human mind is wired to hate losses even more than we love gains.
Good point.
And that's commonly said. If the market increased by 10% over the course of a year, an investor would be satisfied if their portfolio gained, 6 to 8%. But if the market lost 10%, the study says many people don't want to be down more than 2 to 3%. So again, that right there just reiterates the point that we're wired to hate losses even more than we love gains when it comes to finances and investments and different things to that nature.
Okay, so again, when it comes to market risk, understand that you cannot diversify 100% out of market risk. Your portfolio is going to take a hit, okay? However, you can mitigate that loss. So, you look at certain things such as diversification. Diversification mitigates that loss. You don't want to be too heavy in any one particular sector. So when you diversify, you would like to have stocks, bonds, cash, real estate, derivatives, cash value life insurance. Life insurance is not an investment, but it can be used in a retirement plan. So in this situation, cash value life insurance could be utilized. Annuity products. There are a number of different types of annuities out there. People either understand them or don't understand them. Meet with your advisor to find out which is the best for you, if any of them are. So you look at that. Another opportunity is, fly to safety. And again, that is the reflection of building cash when the market is good. Too many investors emotionally make decisions to sell in their portfolio, typically too late in the process. They try to time the market, and that's a dangerous thing to do. Many times they'll let emotion kick in and they'll start selling off the portfolio after most of the damage has been done. We like to tell people in our risk managed portfolios, we do sell and go into a cash position when the market is high. You've captured a gain, not when half the portfolio is lost or you've come to the very rock bottom and then you sold out and went to cash. So emotion comes into play. Don't like that at all. When you fly to safety, what that does is create an opportunity for you to buy low once the market stabilizes a little bit. Ty, what else do we look at here when it comes to positioning the portfolio for a market correction?
And Dean, I'll get to that. Just one more thing I want to add to when it comes to fly to safety is actually a Warren Buffett quote. And Warren Buffett says, "Be fearful when others are greedy and greedy when others are fearful." Meaning this right here illustrates that he likes to buy low and build up cash at a high. So then when and if the market drops, that's, again, like we said, we can go ahead and buy in at a low there. So, again, building cash at a high and then also being able to move out as the market tends to go down. Obviously, we're not going to wait for it to bottom out, but when it gets a little shaky, we have the ability to go out into cash. The other thing that we want to look for when it comes to protecting your portfolio from a market downturn or market correction is to look for different types of guaranteed investments. Whether that is fixed annuities, CDs, or treasuries. Some of those will provide good guarantees where you're safe, you're protected. A portion of your portfolio isn't in the market at all, which can really help withstand any type of market crash or market downturn. And you can, maybe at that time, that's a time to withdraw. If you're taking withdrawals, you might want to look to withdraw from those accounts during the market downturn and let your position in the market, let your stocks continue to defer taking money from those so that way they can bounce back, and then when they recover, then you can go back to withdrawing from them. The other thing to look at is income annuities, where you have annuities that pay out income for the rest of your life, just like a pension. And that's where you're going to want to, especially during a market downturn, try and take from those investments. And keep in mind with annuities, they are backed by the claims paying ability of the insurance company.
Okay. Now, there's one other thing here that a lot of people don't think of when it comes to your portfolio and positioning it correctly for a market correction. It's actually outside of the portfolio, but it helps protect and allows you to let the portfolio recover, and that's paying off your debts. We are advocates. We support the Dave Ramsey thought, which is, build cash, have emergency funds, but also pay off your debt. Aggressively pay off your debt. Here's why. If, let's say, you are going into retirement and you are solely receiving your income from fixed income, such as Social Security, a pension, or maybe you don't even have a pension, just Social Security, then your investments, which were your retirement plans that might have been moved into an IRA, you're getting income from them. When the market is good, you are withdrawing, let's say you're withdrawing 4 or 5%, and if the market is giving you 7 or 8% returns, you're actually accumulating money in that portfolio even while you're withdrawing. What happens if you're relying solely on that investment and you're withdrawing, 4 or 5%, and the market is down 1, 2%? You are now depleting that portfolio quicker than you would when the market is up. Many times you are withdrawing that money. Why? Because you have to pay off debt. You have to pay off mortgage, car, credit cards, student loans, whatever it may be. So that's why we try to work with our clients to aggressively pay off debt before going into retirement. Not everybody can do that. You're going to be taking some debt into retirement. People have to get cars throughout the years in their retirement, and some people have a very affordable mortgage. That's fine. But try to pay off as much debt as you possibly can before you go into retirement. It's going to take some of the stress off of your portfolio if you don't have to draw so much money from that.
Exactly, Dean. And the ideal situation, if you do have debt in retirement, is to have that covered, have your debt as well as your monthly expenses covered by your fixed income alone, and then everything on top of that, all the other leisure expenses, whether it be travel, vacation, visiting grandkids, different activities and hobbies, money for that to be pulled from your investments. But again, paying off debt is something that is overlooked most times when it comes to protecting your portfolio from a market correction or market crash.
Okay. Also there's a term called a hedge. You hear in the investment world, people will say, well, we need a hedge in the portfolio. A hedge is usually an inverse relationship to something that is performing in a different manner. So for instance, a hedge could be a bond position versus an equity-based mutual fund or an ETF or a stock. And when we bring clients in, we show them on the smart board the performance in the portfolio and what it's made up of. Sometimes you'll see something that's performing relatively low compared to the market. It might be a bond position, or right now with the market performing well, a consumer staple or a telecommunications is in there, and it might not be performing real well. And they'll wonder why we don't get out of that and go all in into the tech or the defensive industry, or if we're going to have tax reform, something that's in the small cap. Part of the reason is you want to have a hedge in your portfolio because we do not know what tomorrow will bring, okay? We look at economic conditions, but from a geopolitical standpoint, we don't really know what might happen in like North Korea, Iran, or so on a daily basis. That could bring a market down. So you want to have a hedge in there. Cash also serves as a hedge. A hedge really tends to add a little protection against the momentum that you currently have in your portfolio. So I brought up telecommunications and consumer staples. As an example, those tend to be a little bit more conservative. When the market isn't doing all that well, people flock towards safe havens. They'll also look at telecommunications and consumer staples. When the market's performing real well, those tend to slow down, but they're extremely important in your portfolio. You don't want to be all in to any one particular sector.
Exactly, Dean. And the other thing that you can do if your portfolio is down during a market correction or a market downturn is something called tax loss harvesting. It's a tax concept. It's where you look at your taxable accounts, so your non-qualified accounts, a brokerage account that you may have out there, and that's where you're going to want to sell your losing positions, and then you can buy them back 31 days later, and then you can write off all your losses against any gains. So you're going to have capital losses, and then you can carry forward anything excess up to $3,000 each year against your ordinary income. So again, that's if you already sustained losses in your portfolio, you can look to tax loss harvest in a taxable account, a non-qualified account. One last thing that you can do here, you can look at it as an opportunity to do a Roth IRA conversion, where you may have a traditional IRA that lost money, the market's down, it's depressed, you can then pay taxes on it. However, when the market's down like that, you may actually not have to pay that much in taxes, and yet you get to convert it to a Roth IRA and then have it grow tax deferred and tax free until you withdraw for the rest of your life.
Okay. Well, thanks, Ty. I think we had a good show here. Hope our listeners learned something. We're coming to a close. That's all the time we have this week. See you later, and hope you'll join us again next week.
See you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.